In 2008, the world discovered a terrifying truth. The global financial system was a house of cards. It was a crisis triggered not by war or disaster, but by a simple seductive lie sold to millions. Why rent when you can own? This lie twisted the American dream into a global nightmare. A 158-year-old pillar of Wall Street, Lehman Brothers, vanished overnight. Life savings that people had spent decades building evaporated into thin air. Millions lost their jobs, their homes, and their security. This is the story of how Wall Street built a breathtakingly tall Jenga tower out of bad mortgages, sold tickets to the spectacle, and convinced the world the party would never end. Spoiler alert, it did. Cheap credit, when money became too easy. To understand how the entire world fell off a financial cliff, we have to rewind the clock to the early 2000s. America was still nursing a massive hangover from the dot-com bubble bursting, and the 9/11 attacks had just delivered a sucker punch to an already reeling economy. In response, the Federal Reserve, America's central bank, reached for its favorite tool, the sledgehammer of interest rates. They slashed them again and again, pushing the federal funds rate down to a historically low 1%. Boom. Suddenly, money was dirt cheap, for banks, for corporations, and most importantly, for you. Borrowing became incredibly easy, and overnight, America's favorite pastime wasn't baseball anymore. It was real estate. The housing boom, everyone wanted in. This created a very potent situation. At the same time, a global savings glut meant trillions of dollars held by foreign governments and giant investors were desperately looking for a safe, profitable place to park their cash. The stock market still looked twitchy and unreliable. Government bonds, the traditionally safest investment, were paying next to nothing thanks to those low interest rates. So these giant pools of money were hungry for a better return, and Wall Street was more than happy to cook them up the perfect meal: the American homeowner. For generations, the U.S. housing market was seen as bedrock. The logic was beautifully simple. House prices always go up. People, by and large, pay their mortgages. Defaulting on your home is the last thing anyone ever wants to do. To global investors, it seemed like the safest, most reliable bet in the world. With all that cheap money flooding the system and a housing gold rush beginning, prices didn't just rise, they started to skyrocket, and everyone wanted in on the action. Wall Street's blender, turning mortgages into money machines. This is where Wall Street got creative. A single $300,000 mortgage is too small for a global investor to bother with. So the investment banks came up with an idea. They started buying up thousands of individual mortgages from the original lenders, bundling them together into a giant pile, and then selling slices of that pile to those hungry global investors. They called this new creation a mortgage-backed security, or MBS. Think of it like a master chef making a fruit smoothie for wealthy clients. Each mortgage payment is a piece of fruit. The chef, Wall Street, buys up all the fruit from local farms, the mortgage lenders. They blend thousands of these pieces of fruit together and sell it by the glass. As homeowners make their monthly payments, that money, the juice, flows to the investors. The recipe seemed flawless. On the surface, if a few fruits in that giant blend are rotten, if a few homeowners default, who cares? In a smoothie that big, you won't even taste it. The risk is diluted. Investors absolutely loved it, pouring trillions into these MBS products, believing they were as safe as solid gold but with a much better return. But the demand for these smoothies became so ravenous that Wall Street ran into a problem. They were running out of good fruit. They had already used up all the prime mortgages from borrowers with great credit and stable jobs. The machine, however, had to be fed. So they lowered their standards dramatically. Enter the subprime mortgage. These were loans for people with bad credit or unstable income. To lure them in, lenders offered deceptive teaser rates, adjustable rate mortgages, or ARMs that started with a ridiculously low payment, but were designed to explode into a much higher, often unaffordable payment later on. Lending standards weren't just lowered, they were launched out the window. They had what became infamously known as ninja loans: no income, no job, or assets. You could literally walk into a lender, state your income without any proof, and walk out with a $500,000 loan. People were approved for massive loans they had no prayer of paying back long term. But in the short term, no one cared. The mortgage broker got a fat commission. The local bank immediately sold the loan to a Wall Street investment bank, wiping its hands clean. And the investment bank bundled it into an MBS and passed the risk to the final investor. It was a global game of hot potato where everyone in the chain got paid a fee for passing it along. But Wall Street wasn't done cooking. They took the riskiest slices from hundreds of different MBS smoothies, the rotten fruit, the moldy berries, the absolute junk, and they blended those together into something even more complex, a collateralized debt obligation, or CDO. It was pure financial alchemy. They were taking literal toxic garbage, loans they knew were likely to fail, and through the magic of financial engineering, were labeling them as top-rated AAA investments, the same safety rating as U.S. government bonds. And the official ratings agencies, the supposed independent watchdogs like Moody's and Standard & Poor's, they gave it their highest seal of approval. The agencies were being paid enormous fees by the very same banks whose products they were rating. It's like a food critic telling their client they won't get paid unless they call raw chicken a Michelin-starred masterpiece. The entire global financial system was now a teetering Jenga tower, built on the catastrophically flawed assumption that house prices would never fall. The collapse. When the bubble burst. For a while, the party raged on. House prices kept climbing at a dizzying pace, creating a dangerous illusion of safety. If you couldn't afford your new, higher mortgage payment when it reset, you could simply refinance or sell the house for a profit, pay off the loan, and still walk away with cash. The system seemed to be working perfectly, but it was a mirage, sustained only by constantly rising prices. The first cracks appeared in late 2006. The fuse lit years earlier was finally reaching the dynamite. Those teaser rates on millions of subprime mortgages began to expire. A family's $1,500 monthly payment became $3,000, literally overnight, a brutal reality check at kitchen tables across the nation. For families already stretched thin, it was an impossible leap. Defaults, once a statistical rarity, started to surge. With so many homeowners unable to pay, foreclosure signs started popping up like weeds. This flood of homes hitting the market all at once did the one thing the entire system was betting against. It crushed demand. And for the first time in nearly a decade, the unthinkable happened. Home prices stopped rising, then they flattened, and then they started to fall. The entire machine went into a violent reverse. The escape hatch was gone. Homeowners who were underwater, owing more on their mortgage than their house was now worth, had no incentive to keep paying. Many simply gave up, mailing their keys to the bank in what became known as jingle mail. Foreclosures exploded. Suddenly, those MBS and CDO products, those safe-as-gold investments on the books of banks all over the world, were revealed to be radioactive garbage. The stream of money from homeowners' payments dried up, and the value of these securities plummeted. Panic spread like wildfire. No one knew who was holding the toxic assets or how much they had. So banks stopped lending to each other. The lifeblood of the global economy, credit, simply stopped flowing. In March 2008, the first major domino fell. Bear Stearns, the nation's fifth largest investment bank, was toast, crushed under the weight of its toxic mortgage securities. To prevent a wider panic, the federal government forced a fire sale to its rival, J.P. Morgan Chase, backing the deal with billions. The world held its breath, hoping the worst was over. It wasn't. It was just a tremor before the earthquake. Another giant, Lehman Brothers, was wobbling badly, but having faced political backlash for the Bear Stearns bailout, the government decided to draw a line in the sand. No more bailouts. On Monday, September 15, 2008, Lehman Brothers declared bankruptcy. It remains the largest bankruptcy filing in U.S. history, and it was the moment the panic became a full-blown global meltdown. Letting Lehman fail was a catastrophic miscalculation. It shattered the assumption that some institutions were too big to fail. The message the market heard wasn't "be responsible." It was "no one is safe." Credit markets didn't just freeze, they shattered. The stock market went into a complete freefall. The crisis hit Main Street hard. The very next day, it found its next victim, AIG, the world's largest insurance company. AIG was hours from collapse, not because of its normal business, but because it had sold tens of billions of dollars worth of insurance policies on all those toxic CDOs. These were called credit default swaps, or CDS. It was like AIG had sold a fire insurance policy on the entire global financial system using an empty wallet. The houses were now a raging inferno. AIG's failure would have been an extinction-level event. This time, the government had no choice. It stepped in with a colossal $85 billion bailout, a number that would later swell to over $180 billion. The world was staring into a black hole. The crisis that started with shady loans in American suburbs was now causing the Great Recession, the worst global economic downturn since the 1930s. The bailout, saving Wall Street, angering Main Street. With the global economy in a death spiral, governments were forced to act. The U.S. Congress, in a state of panic, narrowly passed the Troubled Asset Relief Program, TARP, a $700 billion bailout fund to inject capital directly into the nation's largest banks to keep them from collapsing. Essentially, they were giving Wall Street a giant taxpayer-funded pillow to cushion its fall. The decision was, to put it mildly, controversial. To the public, it looked like the government was using their money to reward the very arsonists who had lit the fire. The bitter irony was not lost on anyone. The public was forced to buy a ticket to a rescue mission for the very people who had crashed the ship. While the bankers who caused the collapse got bailed out, millions of ordinary people got pink slips and foreclosure notices. The public rage was immense, and it reshaped the political landscape for a decade. The aftermath, the Great Recession, and what we learned. The human cost was staggering. In the U.S. alone, nearly 9 million jobs vanished. The unemployment rate doubled to 10%. Over 6 million families lost their homes. Trillions of dollars in retirement savings and household wealth disappeared. An entire generation's financial future was crippled, and the psychological toll of lost security and stability lingered for years. In the aftermath, there was a significant push for reform. The U.S. passed the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010. It was a massive piece of legislation meant to rein in Wall Street's excesses, force banks to hold more capital as a buffer, bring transparency to the complex products that caused the crisis, and create the Consumer Financial Protection Bureau, CFPB, to protect Americans from predatory lending. It was an attempt to build financial floodwalls to prevent another catastrophic deluge. So, what is the lasting legacy of 2008? By most accounts, the banking system is safer. The regulations have forced banks to reduce their riskiest activities, but the crisis left deep permanent scars. It dramatically worsened economic inequality as the wealthy recovered quickly on the back of government stimulus, while Main Street choked on the smoke for years. And most profoundly, it destroyed trust. Trust in the banks, trust in the government, trust in the regulators, and trust in the idea of a fair system. A generation learned a harsh lesson. When giant corporations mess up, they get rescued. When you mess up, you get wrecked. Not a single major Wall Street CEO went to jail for their role in the crisis. There were fines, but for the individuals at the top, there were mostly just golden parachutes. The 2008 financial crisis wasn't just numbers on a screen. It was a deeply human story about greed, deception, and a system rigged to privatize profits and socialize losses. Understanding it is crucial because the dynamics that created it, the hunger for profit, the complexity that hides risk, and the seductive promise of easy money are still with us today. If you want to keep untangling how our world really works, make sure you're subscribed with that notification bell on. In the end, the system survived. The banks were saved. The markets recovered. But trust? It was burned to the ground, and it has never fully grown back. The famous investor Warren Buffett once said that the economy is like a train that occasionally goes off the rails but always gets back on track. The 2008 derailment was one of the most violent in modern history, and a study found it cost the average American an estimated $70,000 in lifetime income. And while the train is indeed moving again, all of us are left wondering where the next weak spot in the track might be. Because if 2008 taught us anything, it's that the next crisis doesn't look like the last one. It looks harmless. It looks innovative. It looks profitable. And for a while, it feels inevitable. Until it isn't.